What if I told you that the next banking crisis won't look like the last one? What if, instead of taxpayers bailing out the banks simply reach into your account and take what they need to survive? It sounds like conspiracy theory territory, right? Like something that could never happen in America. But here's the uncomfortable truth. The legal framework for exactly this scenario already exists. It's called a bail-in. And while most Americans have never heard the term, financial institutions and regulators have been quietly preparing for this possibility for over a decade. Let me paint you a picture of what happened in Cyprus back in 2013. It was a small Mediterranean island nation. Beautiful beaches, tourism economy, seemed stable enough. Then one morning, Cypriots woke up to find their bank accounts frozen. Not temporarily, not for a few hours, completely locked. And when those accounts finally reopened, something shocking had occurred. Anyone with deposits over a certain threshold discovered that a significant portion of their money had simply vanished. Not stolen by hackers, not lost to fraud, confiscated by the banks themselves to recapitalize their balance sheets. Depositors became involuntary investors in failing institutions. Their cash was converted to bank equity, often worth pennies on the dollar. The global financial establishment didn't condemn this action. They studied it, they refined it, they codified it into international banking standards. The Financial Stability Board, the Bank for International Settlements, the International Monetary Fund, they all endorsed the bail-in model as the preferred method for resolving future banking crises. And here's what should terrify you. The United States has incorporated these principles into its own regulatory framework through the Dodd-Frank Act and subsequent FDIC resolution planning requirements. Now, before you think this is just about protecting against another 2008-style meltdown, let me show you what's really happening in the banking sector right now. The commercial real estate market is sitting on a time bomb of unrealized losses. Regional banks are loaded with office building loans that are underwater because nobody's going back to the office. Work from home isn't a temporary pandemic phenomenon anymore. It's structural. Those gleaming downtown towers in major cities, many are half empty, and their valuations have cratered. But here's the thing. Those losses don't show up on bank balance sheets until the loans actually default or the properties get revalued. It's a slow-motion train wreck, and the banks are hoping they can extend and pretend their way through it. Then you've got the treasury market situation. Banks are sitting on massive portfolios of government bonds that they purchased when interest rates were near zero. Now that rates have risen dramatically, those bonds are worth significantly less than what the banks paid for them. Again, unrealized losses. Again, not reflected in the headline numbers. But if depositors start pulling their money out and banks need to sell those bonds to raise cash, suddenly those paper losses become very real, very fast. Quick aside here, because this is important. If you're watching this and you've got retirement savings, there's a free guide in the description that breaks down the wealth protection strategies that thousands of American retirees are using right now. It's worth checking out, especially given what I'm about to show you. So here's where the bail-in mechanism becomes relevant. Under current regulations, when a systemically important financial institution fails, the FDIC has the authority to implement what's called an orderly liquidation authority. Sounds bureaucratic and boring, right? But buried in that framework is the power to convert certain liabilities into equity. And guess what counts as a liability on a bank's balance sheet? Your deposits. Anything above the FDIC insurance limit is fair game. And even insured deposits could theoretically be subject to temporary holds or restrictions during a resolution process. Now, I know what you're thinking. The FDIC insures deposits up to a certain amount. You're protected, right? Well, let's talk about what that insurance actually means. The FDIC's Deposit Insurance Fund holds a fraction of total insured deposits. We're talking about a ratio that would make you laugh if it wasn't so serious. If multiple large banks failed simultaneously, the DIF would be overwhelmed almost instantly. Sure, the FDIC has a credit line with the Treasury, but accessing that requires congressional action in many scenarios. And we've all seen how quickly Congress moves during a crisis. Remember March of 2023? Silicon Valley Bank collapsed in a matter of days. Signature Bank followed. First Republic teetered on the edge. The government stepped in with emergency measures, guaranteeing all deposits at those institutions, even amounts far exceeding the insurance limits. But here's what nobody talks about. That was a policy choice, not a legal requirement. The next time around, With a different political environment, different fiscal constraints, different public sentiment about bailing out wealthy depositors, that choice might go the other way. And this is where gold enters the conversation in a way that's fundamentally different from any other asset class, because gold isn't someone else's liability. When you own physical gold, you're not depending on a bank's solvency, a government's promise, or a counterparty's ability to pay. It's not a claim on future performance. It's not a derivative of something else. It's a tangible asset that's been recognized as money for thousands of years, across every civilization, regardless of political system or economic structure. Central banks understand this at a visceral level. That's why they've been accumulating gold at a pace we haven't seen in decades. The People's Bank of China has been adding to its reserves month after month. The Reserve Bank of India, the Central Bank of Turkey, the National Bank of Poland, they're all buying. And these aren't small purchases. We're talking about hundreds of tons annually. These are sophisticated institutions with access to every financial instrument imaginable, and they're choosing to hold physical metal. Why? Because they're looking at the same structural problems in the global financial system that we're discussing. They see the debt levels. They see the derivative exposures. They see the concentration of risk in the banking sector. And they're quietly, methodically, building positions in the one asset that has no counterparty risk. Let's talk about what happened in 2008 for a moment, because there are some crucial lessons there that most people missed. When Lehman Brothers collapsed, it wasn't just Lehman that was the problem. It was the web of interconnections, the derivatives contracts, the repo agreements, the counterparty exposures. One institution's failure threatened to cascade through the entire system because modern banking is built on a foundation of interlocking promises. Everyone owes everyone else, and it all works fine until someone can't pay. The government's response was to inject massive amounts of capital into the banking system. TARP, quantitative easing, zero interest rates, all of it designed to prevent a complete collapse. And it worked, sort of. The banks survived. But at what cost? The Federal Reserve's balance sheet exploded. Government debt skyrocketed. And the moral hazard of too big to fail became even more entrenched. But here's the thing. That playbook might not be available next time. The political will for bank bailouts has evaporated. The public won't stand for it. So regulators have been developing alternative mechanisms. And the bail-in is at the top of that list. It's sold as a way to make bank failures less costly to taxpayers. Instead of the government injecting capital, the bank's creditors and depositors take the hit. It sounds fair in theory. Why should taxpayers rescue irresponsible banks? But in practice, it means that ordinary people who thought their money was safe in a checking account could wake up to find it's been converted into shares of a failing bank. Now let's connect this to what's happening in the precious metals market, because there's a fascinating dynamic playing out. Gold has been pushing toward all-time highs, even as real interest rates have risen. Traditionally, higher real rates are supposed to be negative for gold because gold doesn't pay interest. But that relationship has broken down. Why? Because the smart money is looking past the interest rate environment and focusing on systemic risk. Silver's story is even more compelling in some ways. It's trading at a ratio to gold that's historically extreme. There have been periods in history where that ratio was much tighter, where silver was valued much more highly relative to gold. And silver has this dual nature. It's both a monetary metal and an industrial commodity. The demand from solar panels, electric vehicles, electronics, all of that is structural and growing. But the supply side is constrained. Most silver comes as a byproduct of other mining operations. You can't just ramp up silver production the way you might with other commodities. So you've got this setup where industrial demand is increasing. Investment demand is awakening as people recognize the risks in the financial system, and supply is relatively inelastic. That's a recipe for significant price appreciation. But more importantly, it's a hedge against the exact scenario we've been discussing. If there's a banking crisis and bail-ins start happening, physical silver and gold are outside that system. They can't be bailed in. They can't be frozen. They can't be converted to equity in a failing institution. Let me tell you about a conversation I had with a wealth manager who works with high net worth families. He told me that over the past couple of years, he's seen a dramatic shift in how his clients think about asset allocation. It used to be that precious metals were a tiny slice of a portfolio, if they were there at all, maybe 5%, mostly in ETFs or mining stocks. But now, he's seeing clients who want significant positions in physical metal, not paper claims, not derivatives, actual bars and coins that they can hold or store in allocated, segregated vaults. And these aren't doomsday preppers. These are sophisticated investors, business owners, people who've built substantial wealth and want to protect it. They're looking at the same data we're discussing and reaching the same conclusion. The traditional banking system carries risks that aren't adequately compensated by the returns it offers. Why keep large amounts of cash in a bank earning minimal interest when that cash could be subject to bail-in provisions, when the bank itself is sitting on unrealized losses, when the regulatory framework explicitly allows for depositor funds to be used to recapitalize failing institutions? Here's where it gets really interesting from a retirement planning perspective. A lot of people don't realize that you can hold physical gold and silver inside a retirement account. It's called a gold IRA, and it allows you to get the tax advantages of a traditional or Roth IRA while holding actual precious metals instead of just paper assets. Now, there are specific rules and requirements. You need a custodian who specializes in this. The metals have to meet certain purity standards. They have to be stored in an approved depository, but it's completely legal and above board. And if you're sitting on a substantial retirement account, this is worth serious consideration. Because think about what a traditional IRA or 401k actually is. It's a collection of financial assets, stocks, bonds, mutual funds. All of them are claims on future cash flows. All of them are subject to market risk, counterparty risk, systemic risk. If there's a major financial crisis, if bail-ins start happening, if the banking system seizes up, those paper assets could lose significant value very quickly. Physical gold in a retirement account is different. It's not correlated to the stock market. It's not dependent on any institution's solvency. It's a tangible asset with thousands of years of history as a store of value. And in a crisis scenario, it's exactly the kind of asset you want to own. Now, I put together a comprehensive guide on how gold IRAs work. It's in the description below. It covers the mechanics, the tax implications, the costs, the storage options, all of it. If you've got a retirement account with a substantial balance, it's worth understanding this option, because the window to make these kinds of moves might not stay open forever. If we do see a banking crisis, if bail-ins start happening, the rules could change very quickly. All right, let's get back to the broader picture. Because there's a geopolitical dimension to all of this that's absolutely crucial. The US dollar's role as the global reserve currency has been the foundation of American economic power for decades. It allows the US to run massive trade deficits, to borrow at lower rates than would otherwise be possible, to impose financial sanctions that have real teeth. But that dominance is being challenged in ways that would have been unthinkable a generation ago. The BRICS nations, Brazil, Russia, India, China, South Africa, they've been working on alternative payment systems, alternative reserve assets, ways to conduct international trade that bypass the dollar. And they're not alone. Saudi Arabia has been in discussions about accepting payment for oil in currencies other than dollars. That's huge. The petrodollar system has been a cornerstone of dollar dominance since the 1970s. Now, what does this have to do with bail-ins and banking stability? Everything. Because if the dollar's reserve status erodes, if international demand for dollars and dollar-denominated assets decreases, that puts pressure on the entire US financial system. The treasury market, the banking sector, all of it is built on the assumption of continued dollar dominance. If that assumption breaks down, the stresses we've been discussing, the unrealized losses, the commercial real estate problems, all of it gets magnified. And in that environment, gold becomes even more critical, because gold is the ultimate neutral reserve asset. It's not tied to any particular country or political system. It's accepted everywhere. Central banks around the world hold it precisely because it's the one asset that maintains value regardless of what happens to any particular currency or financial system. Let's talk about the mechanics of how a bail-in would actually work, because understanding this is important. It's not like the bank just takes your money and it disappears. What happens is that your deposit, which is legally a loan you've made to the bank, gets converted into equity. You become a shareholder in the bank. Now, in theory, if the bank recovers, those shares could be worth something. But in practice, if a bank is in bad enough shape to require a bail-in, those shares are likely to be worth far less than your original deposit, and there's no guarantee you'll be able to sell them quickly or at any reasonable price. The Cyprus example is instructive here. Depositors who had their accounts bailed and received shares in the restructured banks. Some of those shares eventually had some value, but it was a fraction of the original deposits, and it took years to realize even that diminished value. Meanwhile, those depositors had lost access to their cash, their liquidity, their ability to pay bills and meet obligations. Imagine you're a retiree living on a fixed income. You've got your savings in a bank account because that's what you've always done, because it's supposed to be safe. Then one day, a significant portion of that account gets converted to bank shares. You can't pay your mortgage. You can't buy groceries. You can't access the money you spent a lifetime accumulating. That's not a theoretical scenario. It happened in Cyprus. And the regulatory framework that allowed it to happen there has been adopted in various forms by countries around the world, including the United States. Now contrast that with physical precious metals. If you own gold or silver, stored securely, it's there, it's liquid. You can sell it if you need to. You can hold it if you don't. It's not subject to someone else's decision about whether to bail in depositors or freeze accounts or impose capital controls. It's outside the banking system entirely. This is why, throughout history, during periods of financial instability, precious metals have been the go-to safe haven. It's not because gold and silver are perfect investments. They're not. They don't generate cash flow. They don't pay dividends. But they preserve purchasing power. They maintain value when other assets are collapsing. They provide insurance against systemic failure. And we're living in a time when the risk of systemic failure is higher than it's been in decades. The debt levels, both government and private, are unprecedented. The derivative exposures in the banking system are mind-boggling. The geopolitical tensions are escalating. The monetary experiments of the past 15 years, the quantitative easing, the negative interest rates, the massive expansion of central bank balance sheets. We don't know how this ends. We've never been here before. But we do know how similar situations have ended in the past. We know what happened in Weimar Germany when the currency collapsed. We know what happened in Argentina, in Zimbabwe, in Venezuela. We know that when faith in the financial system breaks down, when the promises that underpin modern banking are called into question, people flee to tangible assets. And the most liquid, most universally accepted tangible asset is gold. Silver plays a similar role, but with some interesting differences. Because silver is more affordable per ounce, it's accessible to a broader range of people. You don't need to drop thousands of dollars on a single gold coin. You can start building a position in silver with much smaller amounts. And because of silver's industrial applications, it has this additional demand driver that gold doesn't have to the same extent. Think about the transition to renewable energy. Solar panels use silver. A lot of it. Each panel contains a certain amount of silver in the photovoltaic cells. As the world builds out solar capacity, that's structural demand for silver that's going to persist for decades. Electric vehicles use significantly more silver than traditional cars. The electronics in your phone, your computer, your appliances, they all contain silver. This isn't speculative demand that could evaporate. It's industrial consumption that's baked into the modern economy. But here's the kicker. The above-ground stockpiles of silver have been declining. Unlike gold, which mostly gets hoarded and recycled, silver gets consumed. It's used in industrial processes where it's not economical to recover it. So the supply-demand dynamics for silver are fundamentally different from gold, and yet silver is still trading at historically cheap levels relative to gold. That ratio I mentioned earlier, the gold to silver ratio, it's been as low as 15-to-1 in the past, meaning 1 ounce of gold was worth 15 ounces of silver. Right now it's much higher than that, which suggests that either gold is overvalued relative to silver or silver is dramatically undervalued relative to gold. Given the supply-demand fundamentals, given the industrial demand trends, given the monetary demand that's starting to awaken, I'd argue it's the latter. Now, let's bring this back to the bail-in risk, because there's a timing element here that's crucial. The thing about financial crises is that they tend to happen faster than anyone expects. The 2008 crisis went from everything's fine to the system is collapsing in a matter of weeks. Silicon Valley Bank went from a functioning institution to a failed bank in less than 48 hours. When confidence breaks, it breaks fast. And once a crisis is underway, your options become very limited very quickly. If there's a run on the banks, if bail-ins are being implemented, if capital controls are being imposed, you can't just decide at that moment to move your wealth into precious metals. The dealers will be overwhelmed. Premiums will skyrocket. Delivery times will stretch out. And if things get really bad, the government might restrict precious metals transactions entirely. It's happened before. Executive Order 6102 in 1933 required Americans to turn in their gold. Could something like that happen again? Maybe, maybe not. But the point is, once a crisis is underway, your freedom to act is constrained. That's why the time to think about these things is now, when the system is still functioning, when you can still move assets around, when you can still make rational decisions without the pressure of an immediate crisis. It's like insurance. You don't buy fire insurance when your house is already burning. You buy it when everything seems fine, because you understand that the risk exists and the consequences of being uninsured are catastrophic. And the risk we're discussing, the risk of bail-ins, of banking system instability, of currency debasement, it's not some far-fetched scenario. It's baked into the current structure of the financial system. The debt levels guarantee that there will be future crises. The question isn't if, it's when. And when it happens, the people who prepared, who diversified out of the banking system, who held tangible assets, they're going to be in a fundamentally different position than the people who kept all their wealth in the traditional financial system. Let me share one more historical parallel, because I think it's instructive. In the 1970s, the US was dealing with high inflation, economic stagnation, a crisis of confidence in the dollar. The Bretton Woods system had just collapsed. Nixon had closed the gold window. The dollar was no longer backed by anything tangible, and people were scared. They didn't know what was going to happen to their savings, their purchasing power, their financial security. And what did they do? They bought gold and silver in massive quantities. Gold went from $35 an ounce in 1971 to over $800 an ounce by 1980. Silver went from $1.50 to $50. Those weren't just price increases. They were a reflection of people fleeing a system they no longer trusted and moving into assets they could hold, assets that had intrinsic value, assets that couldn't be debased by government policy. Now, we're in a different situation today. The specific circumstances are different, but the underlying dynamics are similar. We've got a fiat currency system that's been pushed to its limits. We've got debt levels that are unsustainable. We've got a banking system that's fragile in ways that aren't immediately obvious. And we've got a regulatory framework that explicitly allows for depositor funds to be used to bail in failing banks. The smart money is paying attention. The central banks are accumulating gold. The wealthy families are diversifying into physical metals. The question is, what are you doing? Are you paying attention to these signals? Are you taking steps to protect your wealth? Or are you assuming that everything will be fine, that the system will hold together, that your bank deposits are truly safe? Because here's the uncomfortable truth. The next crisis might not give you time to react. It might happen over a weekend. You might wake up Monday morning to find that the rules have changed, that your access to your money has been restricted, that your deposits have been bailed in. And at that point, your options are limited. But if you've already taken steps, if you've already diversified some of your wealth into physical precious metals, if you've already set up a gold IRA for your retirement funds, if you've already moved some assets outside the banking system, then you're in a position of strength. You're not dependent on the system holding together. You're not at the mercy of regulators' decisions about how to handle the next crisis. This isn't about abandoning the financial system entirely. It's about recognizing the risks and taking prudent steps to mitigate them. It's about understanding that the promises that underpin modern banking, the assumption that your deposits are safe, the belief that the government will always step in to prevent losses, those promises might not hold in the next crisis. And if they don't, the people who prepared will be glad they did. So here's what I want you to take away from this. The bail-in mechanism is real. It's been used before. It's been codified into international banking standards and domestic regulations. The risks in the banking system, the commercial real estate losses, the unrealized losses on bond portfolios, the derivative exposures, they're all real. The geopolitical shifts, the challenges to dollar dominance, the accumulation of gold by central banks, it's all happening right now. And in that environment, physical precious metals aren't just an investment. They're insurance. They're a hedge against systemic failure. They're a way to hold wealth outside a system that's showing increasing signs of stress. Now, if you've made it this far in the video, you're clearly someone who takes this stuff seriously. You're thinking about how to protect your wealth in an uncertain environment. And I want to make sure you have the resources you need to make informed decisions. That guide I mentioned earlier, the one in the description, it goes into much more detail about gold IRAs, about the mechanics, about the costs, about the storage options. And if you're a retiree with a substantial retirement account, there's an opportunity to schedule a one-on-one educational consultation. No obligation, no pressure, just a chance to talk through your specific situation with someone who understands these markets. The consultation is only available to American retirees with retirement accounts above a certain threshold, but if that describes you, it's worth taking advantage of, because the decisions you make now, in this relatively calm period, could make all the difference when the next crisis hits. And make no mistake, there will be a next crisis. The only question is whether you'll be ready for it.